For those that are listening to the recording and not live, so we do apologize again, why don't you go ahead and tell us a little bit about yourself, buddy?
Born and raised in Canada, but I've been doing this note investing thing for the last 10 years, all from Canada, all in the United States. And it's the banking systems are different just enough where there is no secondary market in Canada for these notes. So all of my investing, all of my business has been in the States for quite a while now. And I don't see that changing anytime soon. I really enjoy what I do. So I'm going to talk to everyone today about investing to make a difference. If you look at some of the most utilized and sought after types of investments these days, a lot of people are looking towards impact investing and something that's going to make a difference, something that's going to help change the world in some way. And I cannot think of a better way to do this for individual lives. So you can talk about environment, you can talk about some other parts of the world that we can help impact. This is talking about individual people, actual real people that we're helping to make a difference in their lives. And so I'm excited to share a little bit about all of this with you. Let me talk a little bit about myself. I did a very brief introduction before, but let me just go into a little bit more so you know a little bit about who I am. So I started in notes in 2010. That means just right after the crash, that's when I got started. And I got involved in non-performing notes. I have been around long enough and I'm fairly well known in the industry. And so I'm actually able to get, when I compare notes with some of my colleagues, I think that I'm actually able to get below average pricing when I'm purchasing. And partially it has a lot to do with these key relationships. Like so many things, and more especially in this business, relationships are absolutely key. And it's so important to be able to have the right contacts and the right people and have good relationships with everybody involved in this space. And thankfully, I've been able to do that. And I'm quite happy about that. People generally, if you talk to other note investors and you talk about Nathan Turner, they'll know who you're talking about. I'm the Canadian note guy. I think one of the only Canadian people doing this. And like I say, everything I do is in the States. I just happen to live in Canada. And one of my key beliefs is treating people with dignity and respect. And that actually came from a book called Bailout Riches that I read not long after I very first got started. I probably read that in, it was probably 2010. And it was written by a fellow named Bill Bartman. And he went even more risky, if you ask me. He passed on a few years ago, but he used to buy unsecured debt. So we're talking about like credit card debt, things like that. That's what he would buy. And then he would try to collect on this unsecured debt. I am not into unsecured debt. I very much like the security and the safety that I get having real estate properties, single family houses as my collateral. But that was one of the main things that I took out of his book is he talked about at one point treating people, I repeated it several times actually, but he talked about treating people with dignity and respect. There's no need to get nasty and mean. I've talked to people about what I do and it's people have from time to time, they say, so you're in the collections business? And that's not at all what I think. I'm actually much closer to a bank than I am to a collector, but there are times when I guess I'm asking people for money. So in some ways, I act as a collector from time to time, but really I'm a bank. And that goes right into what I'm talking about here. What is a note and why am I a bank? So anytime you promise to make a payment to somebody else and it's written down, that is a note. So in our case, we're talking about mortgages, deeds of trust, contracts for deed go by all kinds of other names as well, land contract, agreement for deed, bond for deed, they're all the same thing. And just for simplicity in the industry, we all call them all contracts for deed, or CFD for short. But if you think about yourself, you go to buy a house, you probably don't have that $500,000 needed to buy the house cash. You're probably going to have to go to a bank to borrow money to be able to pay for the house. bank will then give you that money to be able to buy the house. And in turn, they give you a mortgage and a note. And for our purposes, we're going to just call them the same thing, mortgages and notes. We're just going to say that they're the same thing. Technically, they're different, but we won't get into that. It has the terms of repayment. It has what your payment amount is going to be, how long you're making that payment, what the interest rate is, all those kinds of agreements that you agree to. And then that is when that document is established. Where I come in is typically when people stop paying on their mortgage for all kinds of different reasons. There are some common threads in there, but suffice it to say, when people are not paying on their mortgage, I will then approach the bank or hedge fund or whoever owns that note. Sometimes it's just somebody did a personal deal with somebody on a second property they own. But I will approach that company and say, okay, so they're not making payments to you. I understand that's a problem for you. Let me see what I can do. We'll take a pause here just for a second, just to show the problem, I guess, that we're facing. This is a chart showing total amount of household debt in the United States. This goes up to the end of 2020. So it's a little bit old, but not much. We're missing about a year's worth of data. So since 2003, the total household debt has doubled. So we're talking about nearly $15 trillion of household debt in the United States. And this is what that looks like. Mortgage debt, of that total debt, about 70% of that is household debt, is in your mortgage. And between 2000 and 2021, the average delinquency rate ranges somewhere between 4.2 and 9.3%. So people take out these mortgages. It represents a huge portion of whatever debt that they are carrying. And what we're seeing is that debt amount is increasing very steadily. And then there's a default rate there. Just for easy numbers, let's call it 5%. So every year, around 5% of people default on their mortgage, and they're not able to make payments for all kinds of different reasons. And then that creates problems. You got the banks that are holding these mortgages, and then that's a problem. So how do banks make money? They make money with interest and fees. They don't make money when people are not paying on their mortgage. They don't make money when people are not making payments, and then the bank has to do a foreclosure. Banks don't make money by doing real estate. They make money on interest and fees. So if somebody quits paying on their mortgage, that becomes a big problem for the bank. This is one that I saw early on, is banks have very, very narrow parameters. So when they say, we've lent you this money at this interest rate for this amount of time, they do not have a lot of wiggle room. It's very difficult for banks to be any kind of creative to be able to come up with solutions for people. Some of the very, very small banks, perhaps. Some of the credit unions, maybe. But by and large, banks just don't have the flexibility to go outside of whatever box they've set. They're also dealing with warehouse lines of credit. And what this means is where do banks get money to lend? They get it from these warehouse lines of credit. And what happens is, and we saw this particularly 2008, 2009, 10, when we had so many defaults back then, banks are only allowed to have a certain percentage of bad loans on their books. Once that becomes too high, the bank becomes insolvable, and it's not good. And so they are very, very motivated to get rid of these bad loans on a regular basis. We have not seen the same kind of default rate that we saw back in 2008. And I'm not anticipating we're going to see that level of default again anytime soon. But the fact is that those defaults happen, and that becomes a problem for the bank, and they need to cycle it through. At the very least, they need to get rid of this stuff. And this is where the impact investor comes in. The best definition of an entrepreneur that I've ever heard is somebody who solves problems for profit. And I think that is so applicable. That's really all we're trying to do, is we're trying to help somebody, we're trying to solve some problem and make some money at the same time. So when it gets to me, I've got all kinds of flexibility. I can do all kinds of creative things that the bank just can't do because they've got their set box and they can only do whatever's inside that box. I hardly even have a box. I can do all kinds of different things. What a fantastic way to revitalize neighborhoods. It is so often that I will pick up a non-performing note, and I talk about non-performing. I buy both performing notes where people are making regular on-time payments, and I buy non-performing where people are not making any payments at all and maybe haven't for a couple of years. So I'm able to go in there and buy the mortgage on the property, take back a property and sell it to somebody local who's going to fix it up and make it better and sell it to somebody who deserves it in the neighborhood. I love that this is all secured by real estate. When I read Mr. Bartman's book, he's talking about unsecured debt, and I think that is risky. That's really, really risky. You're spending money on something with no guarantee of getting it back and no way to ensure that you've got any kind of value there. What we're talking about is mortgages are always secured by real estate. This is something we came up with here a few years back, but the point of it, and I don't want to get too much into the weeds here, but the point of this is just to show all of these green little oval things at the end all represent some kind of different exit strategy. So when we're talking about being secured, this is what we're talking about. When we're talking about being flexible, this is what we're talking about. We've got all kinds of ways that we can continue to make money on this and help people at the same time. And that's really, really nice. Here's just a couple of examples. Here's a property, Jessup Street, out in Delaware. And part of the row housing that is so popular in the New England area. But this is this lady living in this property. So she had signed a lease option contract. And what that means is she was paying as if it was rent. A portion of her payment every month was going towards the purchase of the property. And after, I think it was 3 years, she was expected to pay off the rest of the loan. And in that way, she was going to be able to buy the property. Of course, what happens is that 3 years comes around, she doesn't have the money. So I bought this note. First thing I noticed is with the percentage or with the money that was being taken off of her payment to go towards the principal, to go towards the purchase of the property, the interest rate was the equivalent of about 11%. So it's a pretty high interest rate. I was able to talk with her and we were able to figure out that we could do things better for her and help her save some money. And we converted this to that other kind of contract I mentioned, a contract for deed. And we're actually able to lower her interest rate. At the same time, we're actually able to lower her monthly payment. So she was able to save $15 a month. I know that doesn't sound like a whole lot of money, but it's a lower payment than what she was paying before. Just to give you some really quick numbers on this. So I bought the loan on the property, not the property itself, but the loan on the property for $35,000. And with the new terms that we negotiated with this woman, I was able to have a yield or an ongoing return of 16.5%. So that works out really, really well. So just to explain that a little bit, the balance on the loan was about 50,000, 55,000, somewhere in there. I was able to give her 9% interest rate at her new monthly payment, saving her $15 a month. And because I had bought it at a discount, because I had only paid $35 for it, that's how I get that yield of 16.5%. So that works out great for everybody. So the question is, well, why would you do that? Why would you take less money and do a lower interest rate if she was already paying at the higher interest rate? A couple of things. Number one, a contract for deed. If I choose to sell that loan sometime in the future, it is much easier for me to sell a contract for deed than it is a lease option contract. And then for her, it provides her all kinds of more security under that contract for deed. Now she's getting tax credit for that as well, besides saving the money, besides having a lower interest rate. So it really is a win-win-win all the way around. So I love that kind of a deal, and that's not uncommon. That's the kind of thing we do all the time. Let's look at one where it was a non-performing note, and then I sold it on terms. So here's what I mean by that. This one is Green Drive. This is in Mississippi, and one that we just finished recently. So completed this foreclosure. It was a vacant property, so that we had clear title to the property at that point. And then we put it back out for sale and offered terms. So rather than somebody having to get a loan from the bank, they could get terms, whatever terms they might be able to get from a bank, they could get that through me. Oftentimes they will do that because maybe their credit score isn't high enough or something else. Maybe they're self-employed and some other way where they're not able to qualify with the bank. Because of that, I do take some advantage in that where I will charge a higher interest rate. And I think I feel good about that. I feel that's fair because they want to be able to own the house. I'm helping them to be able to own a house in this way. So we're able to sell this to this wonderful woman. I purchased the loan on this for $67,000. Had a little bit of expense with the foreclosure, not a whole lot. Here's the terms that I sold. So she approached me and the realtor, and she said she had $25,000 to put down. The sale price on this was $90,000, so she paid $25,000 down payment. We wrote this at a 10% interest rate over 15 years. That's her payment amount there, just under $700 a month. And again, because I was able to get this at a discount, because I was able to buy it on sale, we ended up with a yield of 17.19. So the yield, just as a quick explanation, what that means is for the next 15 years, over the life of that term, I will be making 17.19% per year over the life of the loan. Not bad. I'm quite happy with that. And we're able to help this woman out. And she's living in the house and making payments, and she's great. Let me show you one more here. It's foreclosure. And we sold this house to a local. So this was kind of a fun one. This is in Tennessee, Ridgeway Avenue. You'll see there that little orange sign that says no trespassing. Here's how that came to be. The woman that was living in the house, this is another vacant property, completed the foreclosure, and the deadbeat grandson was crashing at the house and making a mess and being a real nuisance to the neighbors. So it was actually the neighbor that I spoke to, and I was in very close contact with him all throughout the foreclosure process and then thereafter until the property sold. The neighbor is the one who actually put up that no trespassing sign. He was the one that cut the grass. The neighbor is the one that I spoke to at least once a week while this was all going on, and helping him help the neighborhood. And the whole neighborhood couldn't wait to get rid of this deadbeat grandson that kept coming around. And so that worked out very well for them. So we completed that foreclosure. The neighbor helped take care of the property all throughout the whole process. And then a local investor is the one who bought the property. He's going to go and fix it up and sell that for whatever he's going to sell it for. We bought this loan, 28.5, sold the property for 45,000. Overall return on investment on that's 28%. Again, that is not bad. And we're helping to revitalize the neighborhood and keep it up and help people all at the same time. So here's the beautiful part is how do you get involved in all this, and how do you help people? Earnest Investing LP is my company. So we actually created a fund just at the end of last year. So I am raising capital for that fund so I can continue to go out and help people and revitalize neighborhoods and help people stay in their homes and keep doing what I love to do. This one actually is, because it's a registered fund, it is only open to accredited investors, unfortunately. I wish that could be different, but that's a matter for the government to figure out. This is a 5-year term, 8% preferred return. They pay that out quarterly. Minimum investments, 50,000, maximum $1 million. And the beautiful thing, like Ramaz was saying, is you're doing this all in your IRA. So you are acting as a lender, lending my company the money for an 8% preferred return, knowing that you're helping people and knowing you're helping to revitalize neighborhoods all at the same time. So I'm asking you to help me to help others and get involved in that way. This is my contact information. I would love to talk to you some more about this. I know I went over quite quickly and somewhat briefly about the business, but the point I hope I'm driving home is this is a fantastic investment for your IRA, and it's a way that you can help other people without lifting a finger.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.